All right, let's talk about something we all think we know. It's a basic rule of economics, right? When the price of something goes up, people buy less of it. Simple, intuitive. But what if I told you that fundamental rule is sometimes just plain wrong?
And no, this isn't some trick question from an econ textbook. It's a real-life economic puzzle that literally flips everything we thought we knew about supply and demand completely upside down.
So this weird exception, it actually has a name. It's called a Giffen good. It's named after an economist, Sir Robert Giffen, who noticed this totally bizarre behavior among the poorest people back in the Victorian era. And it all had to do with the price of bread.
Okay, so for this kind of bizarre situation to even happen, you need a very specific set of ingredients. First, the item has to be a basic staple, what economists call an inferior good. So think potatoes or rice, definitely not a steak dinner. Second, it has to take up a huge chunk of your budget. And third, and this is really important, there can't be any other cheap options to switch to. When all those things line up, you're not talking about consumer choice anymore, you're talking about pure survival. All right, let's make this real. Imagine your entire daily food budget is just $6. As you can see, with bread at $1, you can grab 2 loaves and treat yourself to a little slice of cake. Life's okay. But then, boom, the price of bread doubles. Suddenly, that cake, it's a distant memory. To just get your 3 meals a day, your entire $6 now has to go to bread. Think about that. The price of bread went up, but you ended up buying more of it? That's the Giffen paradox in action.
So that's the consumer side of the equation. But what about the company setting that price? Well, let's flip the coin, because their decisions can be just as weird and, honestly, just as counterintuitive.
If you took an Econ 101 class, you definitely heard this rule. Fixed costs shouldn't affect your prices. Stuff like your factory's rent or that giant machine you already bought. They call them sunk costs. The money's already gone, it's water under the bridge, so it shouldn't have any bearing on what you charge for a product today.
Yeah, but that's the textbook. In the real world, when a business is just desperately trying to keep the lights on, those rules, they fly right out the window. Just like with our bread buyer, for a company, survival changes the whole game. And this slide really nails the difference. On one side, you have the standard theory. Play the long game, maximize profits later, don't worry about those fixed costs. But then you look at reality for a business that's low on cash. Their goal isn't 5 years from now, it's making it to next week. They don't have the luxury of ignoring those big bills. They have to raise prices to cover them, just to avoid going bankrupt.
And this is where the theory really breaks down. See, keeping prices low is like an investment in your future. It builds customer loyalty. But you can only make that investment if you have the cash to float yourself through the tough times. If you don't, you're forced into a painful choice. Sacrifice your future growth just to survive today.
Okay, so let's zoom out a bit, because this isn't just about one struggling company. When that one business is forced to jack up its prices, it creates a ripple effect. Their customers, who are often other businesses, suddenly have higher costs. And what do you think they do? Yep, they pass it right along the supply chain.
And that chain reaction, it has a name too. It's called cost-push inflation. This is super important. It's not inflation because everyone suddenly wants to buy more stuff. No, this is inflation because the fundamental cost of making this stuff is going up. And that cost gets pushed along until, well, it lands on us, the final consumer.
This chart shows us what that looks like for the entire economy. That line labeled AS is the aggregate supply, basically all the stuff our country can produce. When costs go up across the board, it gets harder and more expensive to make things, so that whole curve shifts inward, to the left. And look where we end up. It's a nasty spot. Prices are higher, but the total output of our economy is lower. Not good. So you might be wondering, wait a minute, shouldn't the market just fix itself? Prices go up, people buy less, so prices come back down. It's the biggest question in macroeconomics. And the answer is, well, it's simpler and way more profound than you might think. It comes down to this. In the real world, prices and wages are sticky. That's the term a legendary economist, John Maynard Keynes, used. He realized the economy isn't some perfectly oiled machine. It's got friction. Things get stuck.
So what that means is, when the economy takes a nosedive and demand falls off a cliff, prices and wages don't just politely adjust downwards. They stubbornly refuse to budge. They stay stuck where they were.
And this isn't just some abstract idea. There are real human reasons why things get stuck. First off, who wants to be the first person at their company to say, yeah, sure, I'll take a pay cut? Nobody. That's the coordination problem. Then you've got menu costs, and that's a literal thing.
It costs a restaurant real money to reprint all their menus. And of course, businesses are terrified of ticking off their customers by changing prices all the time. All these little things act like glue, gumming up the gears of the economy.
So what happens? Well, if prices are stuck too high but nobody's buying, goods just pile up on the shelves. And when a company can't sell its stuff, what does it do? It stops making more. It stops hiring. It starts laying people off. And that, in a nutshell, is a recession.
So, if the market gets stuck like this, what do? How do you unstick it? This question gets us right to the heart of a huge debate about the role of government and companies in a modern economy.
This is where the government's toolkit comes in. Keynes argued that in these situations, the government has to step in. If we're in a recession, they can use what's called expansionary policy. They cut taxes or spend more money to get demand going again. On the flip side, if the economy is running too hot and causing inflation, they can do the opposite, raise taxes or cut spending to cool things off.
But it's not all on the government. Businesses have their own toolkit. The key is to be proactive, not reactive. You don't just have to accept a price hike from a supplier. You can push back, demand to see their justification, use your own data, try to negotiate a better deal. It's all about actively defending your business, not just getting pushed around by the supply chain.
It's kind of wild when you think about it. We started this journey with one person and a single loaf of bread, and we've ended up talking about the huge global forces that can lead to inflation and recession. It really shows how everything is connected.
So I want to leave you with this one big question. All these weird paradoxes, Giffen goods, sticky prices, all of it, are they just bugs in the system? Flaws that we need to engineer our way out of? Or are they a feature? Are they just the natural, messy, and inevitable result of an economy that's not run by algorithms, but by us, by human beings?